The stock market plunged and now it's rebounding. Is that an indication that the economy will do the same? Or are the markets acting in a hopeful manner? Or are they responding to people who are trying to capitalize on perceived opportunities? Or both, or not. Those who are fortunate enough to have money in investments are watching the swings and asking themselves, well, what do I do? If I have money in the market, I may very well be asking, do I hang on or do I sell this stock and buy another one? Do I get out of the market now and take a wait and see attitude? Well, the questions are many and the answers are equally varied. Murray Leith heads up Odlum Brown's research department and he says, quality companies are essential to a well-rounded portfolio. They provide stability. He also notes, however, that wild fluctuations do create opportunities and capitalizing on those opportunities requires an in-depth understanding of how markets function. Leith says there's a real tough trade-off in markets with out-of-favor stocks because they sometimes get so cheap and so hated that they can do well as stocks even while the business struggles. They can go from hated to just disliked, and in doing so, jump 50% in value. Leith goes on to say, in the past, that strategy has proven to be successful under the right circumstances. But he says the underlying fundamentals of the market were different then than they are now. He says you need to have a long-term strategy that takes into account the economic backdrop and what types of companies you want to invest in. We invited Murray Leith to join us for a conversation that matters about the state of the investment world, its relationship to the economy, and how to proceed if you are in a position to invest.
Conversations That Matter is a partner program of the Center for Dialogue at Simon Fraser University. The production of this program is made possible thanks to the following and viewers like you. Please become a patron at conversationsthatmatter.tv.
Murray Leith, thanks for joining me for this conversation. You know, as we wind our way through this COVID situation, we've watched it have a tremendous amount of impact on the markets. And there's an awful lot of people who have been saving money and they've been investing in it. And now they're saying, okay, now what? What do I do? How do I navigate my way going forward? The markets seem to be responding almost differently to the rest of the world. Is this a good time for me to get back into the market or get into the market?
I'm not sure that I'd frame it that way.
Okay.
I think it's important for people to save money. And I think it's important to have exposure to high quality businesses in a portfolio. I think balance is more important than ever. So a balance between stocks and bonds, and whether we're talking stocks, bonds, or any other asset class for that matter, I think quality is paramount in the world that we live in today because it's much riskier world, and the future is uncertain.
Well, there's a lot of people who would be saying, okay, well, how do I quantify quality right now? Because stocks or investments that may have looked pretty good a few months ago aren't looking so good now. So how do I start to then create some sort of a vision of what would constitute a good portfolio?
Yeah. Well, we define quality along with a number of metrics, but profitability. We're interested in the companies that are more profitable. We're interested in businesses that have good cash flow. We're interested in businesses that are growing. For parts of the portfolio, we want more stable businesses, be it utilities or telephone companies, or we want companies with strong balance sheets. We live in a world in which, unfortunately, we've learned as we've come into this pandemic, is that a lot of individuals, a lot of businesses, and even governments have not had a lot of rainy day funds. So ill-prepared for turbulent times. And so we're interested in those businesses that are resilient.
So going into this pandemic, there was already sort of indications that the economy might be going through a shift, that there were sectors that were not as strong as they might have been. How would you classify where we're at economically as a whole right now? And then maybe we can start to look at some of the sectors that you think are worth really paying attention to.
Yeah, well, that's a good question. And I think, if I go back to what our mindset and expectations for the economy were, heading into 2020, we generally had expected the global economy to pick up a bit, albeit from a pretty sluggish, muddle-through pace. We've never experienced really robust growth since the great financial crisis a dozen years ago. It's been the longest expansion. It was the longest expansion since World War II, but it had also been the weakest. And I think there was two drivers of that. One was very high levels of debt in the world, and the other was demographics. Populations were growing much slower. Working age populations growing much slower than they used to. So the combination of those things, and also sort of the divided world that we live in, social unrest was leading to trade friction and protectionism, and those factors were contributing to a slower growth world. But last year, the central banks, the Federal Reserve and others, had lowered interest rates, and so the influence of those lower interest rates was the economy was picking up as we came into 2020. So that was positive from the perspective of the outlook for the markets and the economy in general. But we were starting to worry about really the lack of resilience, the high levels of indebtedness, particularly corporations. Monetary policy has been sort of saving the market's bacon every time we have a setback by lowering rates and encouraging more borrowing. But before we came into this, we had negative interest rates in Europe and Japan. And we had very low interest rates in North America. So we were starting to worry about what was going to happen when we had the next inevitable setback. We were going to have to rely more on fiscal policy and less on monetary policy. And in a divided world, we were worried about how that was going to work. So we were starting to think about, we didn't see economic storm clouds on the horizon. We weren't worried about an imminent recession so much. We thought it was further out. We didn't see a pandemic coming, but we were thinking about what types of businesses did we want to own as we moved closer towards the next economic setback. So we were advising clients to focus on those more profitable businesses, the businesses with the better balance sheets, more stable businesses over less cyclical business. Also bigger businesses. Bigger companies tend to fare better when you go through tougher economic times. Now, as I said, we weren't predicting it. The pandemic came out of left field, but we were generally moving in the direction of higher quality businesses, companies with more resilience to withstand an economic cycle.
And are you seeing that those companies are more resilient?
Absolutely. If there's really there's a number of different ways to look at the market. Growth stocks versus value stocks. Growth's doing a lot. Companies that can deliver growth are understandably a lot more popular than those that are struggling in a weaker economic environment. So growth stocks have been outperforming value stocks for about 12 years, or really since the great financial crisis. Big companies have been beating small companies. Companies with stronger balance sheets have been doing better than those that are more leveraged, and stable businesses versus cyclical businesses. Just all the quality attributes that I talked about. They're pretty popular, and understandably, and so those stocks have done better than the rest of the market. So you've got a case of you've got a the Amazons, the Googles, the Apples, like those sorts of businesses are still doing well. The Microsofts in this sort of environment where cyclical, energy companies are doing very poorly. So there's really two buckets of stocks out there, or businesses out there. Some that are doing very, much better fundamentally, and their stock prices therefore are doing better versus the rest.
Right. Well, the energy sector for sure got hammered. We saw not only the challenges that were presented to it by the interesting interplay between Russia and OPEC, but then, of course, the demand for energy plummeted when people were forced to stay home, and travel literally came to a halt. But this brings up the issue of the resource sector. Do you see it as being something that is going to in essence, lay low for quite some time because the demands for the products has diminished?
That's a great question, and there's a real tough trade-off in the market today. You know, out of favor stocks, value stocks, you know, sometimes get so cheap and so hated that they can do well as stocks, even while the businesses still struggle.
Okay.
You know, they can go from hated to just disliked, and that can, you know, they can jump 50% on that.
But that's a dangerous game to try and play, that one, isn't it?
Well, it's a game I played a lot more earlier in my career. I've been at Alden Brown for 26 years now. And in the first 10 years, the economic backdrop was a lot healthier, I'd say, than it was today. But you could play out of favor sectors, and we've done it all along the way, and have faith that the economy is going to come back and the business would get better. Sometimes it doesn't have to get a whole lot better, though, when things are really hated and stock prices are really discounted. So you've actually seen the energy stocks have a bit of comeback in the last number of weeks, and there's been some pretty impressive returns. And those that sort of were the least resilient, the worst balance sheets, had the stocks that were most beaten up. Some of them are up more than 100%, but it's off a very low base, and it was a pretty rough ride to get there to rebound off of that. We try to think more looking out 3 to 5 years. What's the economic backdrop going to be like? What sort of businesses do we want to own through the whole piece? And while we have a little bit of appetite for those cyclical businesses, the higher quality ones in those cyclical arenas, we really want our portfolios right now skewed towards just the better businesses, the less cyclical businesses, the ones that have the really fat profit margins, because it's the businesses that have the profits and the cash flow that can invest in their products and services and their people and their operations. They're the ones that end up, you know, they can invest in marketing. You know, they can grab market share during the tough times. They can consolidate markets. It's kind of the best get better. And it's a theme we've been playing for many years, or concentrating on for many years. And I think the theme only gets stronger in the environment that we're in.
So you mentioned some of the biggies in the tech sector, and so there are obviously going to be some interesting opportunities there. Amazon, I'm sure, is just going crazy because everybody's now ordering online and having it delivered to them rather than standing in the lineup at the store, and that's probably not going to go away for a while. But there are other tech companies that are kind of in that sharing economy, you know, like Airbnb and Uber and whatnot, where people are going to go, whoa, I don't know that I'm going to go into somebody else's house right now or going to get in somebody else's car. So you have to be careful. You can't just say that it's going to be all tech companies.
Yeah, no, you have to be selective. And the other thing you need, you know, there's no free lunches out there. You know, Amazon, clearly, it's obvious to everybody that they're benefiting and their business is accelerating because more and more people are ordering online. They also have a big cloud business, and businesses are investing a ton in that, as you can understand in the world that we're in. But it's well recognized by the market. You know, it's a stock that we've owned for a long time, but it's more pricey than it ever has been for obvious reasons. And when you pay up for a stock, that has an impact on its future returns. And so I think the stock, I haven't looked in the last couple of days, but I think it's up like more than 40% year to date. You know, in the world that we live in, that's pretty good. But that 40% that we get this year is 40% that we're not going to get next year or down the road. So we have to temper our expectations. And, you know, something that's, you know, I talked about the quality part of the market and say the rest. And the valuations are high, you know, because these stocks are popular and pricey, and the rest are pretty cheap. And, you know, for most of my career, you could find a high-quality part of the market that you really were excited about the business fundamentals and where the businesses were going, and you could find pockets where they weren't super popular and super pricey. You know, like in the late 90s when everybody was excited about technology or U.S. blue chip stocks, we told people to keep their money in Canada because we had a lot of high quality companies in Canada across a wide spectrum of industries, and they were very much out of favor. Canada was hated at the time. So you could get both quality at a great price. You know, in the lead up to the great financial crisis in like 2005, 2006, 2007, the world was growing nicely. China was booming. Canada was on top of the world. People loved cyclical resource stocks. We'd ridden much of that wave, but sort of in the mid-2000s, we started to notice that high-quality blue-chip stocks in the U.S. were very much out of favor. They were way overpriced at the turn of the century, and they'd come down. You know, their valuations had come down by 2/3.
Yep.
And so when everybody loved cyclical resource stocks, we said, you know what, there's a better high-quality alternative south of the border, much higher quality than cyclical resource stocks at a great price. So you can get quality at a reasonable price. Today, quality comes at a very high price. I still think it's the place to be.
Right.
But I think you balance that off against having fixed income, even having some gold, which is not something I've liked for years. You know, the central banks are printing a lot of money.
I know, and that
You were
raises
probably
another
gonna get
issue.
to it.
Yeah, they're printing a lot of money,
Yeah.
and the government is spending an awful lot of money. What does that do as far as our economic prospects, and how does it create some sense of certainty or security for anybody who's looking to save money, especially from an investment perspective?
Yeah, well, you know, there's a lot of unknowns here. And, you know, when central banks print a lot of money, it naturally causes people to worry about inflation. Of course, they did a lot of that after the great financial crisis a dozen years ago, and people expected inflation. We never got it. It never showed up.
Right.
And part of it is when we go through these traumatic events, people stop passing the money around as fast. And so there's, when they create more money, you know, the central banks can create the money, but its impact on inflation and in society depends on how quickly people pass the money around. Sort of the velocity of money is a term that they use in economics. And what happened after the great financial crisis is that they printed a lot more money, but the velocity went down. We stopped passing it around much, so that we didn't create the inflation that we expected. And so they're printing a lot more money and promising to, you know, liquefy the system with a lot more money this time than they did last time. So there is a worry that there's going to be inflation. But I think you have to stop and say, well, why are they doing all of this? Like the economy has come to an abrupt stop, not, you know, all around the world.
Right.
And so they need to create a whole bunch more liquidity and money in the system just to starve off a depression, really.
Well, sure, because if it stalls out, getting started again is going to be incredibly difficult.
As we go through this, will there be deflationary forces? Will there be inflationary forces? I think the bigger risk near term is deflation. And that's part of the reason why we want to own businesses that have pricing power, that have goods and services that are in demand, because in a deflationary environment, the average company's going to really struggle.
Yes.
So you want to own the best businesses. But if we had outright deflation, your fixed income component of your portfolio is going to provide a lot of ballast if prices are falling. If we ultimately get inflation, we may very well, because the authorities are throwing a lot at this, and there's a chance that they overdo it and create inflationary period. That's why you want to own your high-quality businesses with the pricing power.
So would you say that you're optimistic about the near term, or are you a little bit more bearish?
That's a great question, and you know, I'm still very much my personal portfolio. I'm 80-85% invested in the stock market. I have more cash and gold than I have historically, but that's to counterbalance. So I what you would call a more aggressive investor. I'd say our typical client would be more towards, you know, 70% stocks, 30% fixed income, even 60-40 probably is closer to the more typical balance that I think our clientele is more comfortable with right now. So am I bullish or bearish? I think I'm bullishly positioned in terms of believing in businesses or great businesses as the way to both preserve and grow wealth over time. But bearish in that I'm recommending more balance than I have historically between stocks and fixed income, because I do believe we live in a riskier world, and quality therefore matters more, and balance matters more. But rather than calling me bullish or bearish, I just like to think of myself as being realistic.
Well, I've always thought that you were very prudent, because I believe that I've listened to you for a number of years. You say invest in solid companies with a good market position and strong leadership team. And so I keep thinking that in virtually every sector, there are those companies.
Yeah.
But it's a question about being able to find them. And this is why you need to have help in doing so. I can't imagine that this is an easy thing for an individual investor to find for themselves.
Well, it's not as hard as you might think.
Oh.
We talk about an Amazon, like that's obvious to most people, and yeah, there's some businesses that are not as obvious. They're more off the beaten path. But when you're talking about the big businesses, they're the ones that they talk about on the business news. You can actually figure out in this market, at least, like quality is rising to the surface.
Yeah.
So the stocks in whatever sector you're talking about that are doing better are the higher quality businesses. Now that's not always the case.
Right.
Quality got very expensive in the late 90s, and it got to a point where people paid too much for quality. So that is something we have to be cognizant about. At some point, it's human nature to overdo things.
Yes.
And we will overdo it. I don't think we're there yet. I think the popularity of quality makes a lot of sense. And I think although prices have risen for quality, I don't think they're too high yet. But they're high enough that we have to coach our expectations with regard to returns down the road. I don't think big double-digit returns are in store for the next decade in stocks. Perhaps in some of the really beaten up stuff.
Yeah.
But you better get a decent economy on the other side of this to count on that.
Yeah.
We're not making big bets there because I'm not so sure the economy is going to be, I don't think we're having a V-shaped recovery. I think, some people have called it, it's going to be more like the Nike swoosh.
Yeah.
Hard down and gradual up. And I think that's what we're going to get.
And so therefore, come back to what has been your repeated message: don't invest for the short term, have a long-term view.
Absolutely. And
you still remain positive about the long term.
Yeah, this is a really difficult period, but we'll get through it.
Thank you very much.
Thanks, Stu.